Hello and welcome to Money Minutes, your quick guide to making money. I am Kayezad E Adajania. Now, there are all kinds of debt funds in the market. If you have been investing in mutual funds regularly, you would know that. Some debt funds focus on the short term and some debt funds focus on the long term. And today, we are going to talk about those debt funds that focus on the very short term. Now, there are two kinds of debt fund categories that fall in this bracket. One is the liquid fund and the other one is the ultra short-term bond fund. You need to make sure that these very short-term debt funds like liquid funds and ultra short-term debt funds are meant to just park your surplus cash. They are not meant to invest. Like for instance, if you have some money in the stock markets and if you have booked profits and if you're looking for a temporary space to park your money till the time that you find the right opportunity to deploy it back, you need to look at liquid funds or ultra short-term bond funds. These funds are also an alternative to putting your money in a savings bank account. So if you put your money in a savings bank account, you would earn an interest rate of about 4% to 7%. But if you invest in a liquid fund or an ultra short-term bond fund, you stand a chance to earn up to 8% or 8.5% interest. So that's what these two funds are about. Now, before we get into the difference between a liquid fund and an ultra short-term bond fund, let me give you some background as to how ultra short-term bond funds were born. Now, in earlier times, there were only liquid funds. Ultra short-term bonds were not there. Budget 2007 hiked the dividend distribution tax on liquid funds to 25%. Other funds in the meantime, other debt funds in the meantime, continued to impose a dividend distribution tax of 12%, which means that liquid funds started to impose a higher dividend distribution tax. So liquid funds obviously lost their advantage over other kinds of debt funds. Later that year, SEBI also came up, the capital market regulator SEBI, they also came out with a circular defining exactly what a liquid fund is. So what they said was that the liquid funds will not invest more than 10% of its securities in mark-to-market securities, which means that the relative attractiveness of liquid funds also went on because they became more conservative. And last but not the least, in around 2006 and 2007, the short-term yields also crashed, they came down. As against the long-term debt yields, so which means investing in slightly longer-term debt papers attracted more returns as compared to investing in slightly lower maturity debt papers. So all these three incidents gave rise to a new category of mutual funds called ultra short-term bond funds. Earlier it was known as liquid plus schemes, but in 2009 again it became known as ultra short-term bond funds. Let's now take a look at the difference between liquid funds and ultra short-term bond funds. Liquid funds would invest in securities not maturing more than 60 days. Ultra short-term bond funds can invest in securities which mature after 60 days. Now, typically, the average maturity of an ultra short-term bond fund is 9 months to a year, which means, in other words, that if you wish to invest your surplus cash up to a period of 1 month, you need to look at liquid funds. But if you want to stash away or if you want to put away your cash and if you want to invest for a period of 1 month to 9 months, then take a look at ultra short-term bond funds. In case of liquid funds, if you submit your application before 2 o'clock, you will get yesterday's NAV. If you submit your application after 2 o'clock, you will get today's NAV. In the case of ultra short-term bond funds, the cutoff time is 3 o'clock, which means that if you submit your applications up to 3 o'clock, you would get today's NAV. If you submit your applications after 3 o'clock, you will get tomorrow's NAV. So that's all for me for today. Do log into livemint.com for more videos of Money Minutes. Thanks for watching.